Okay. Yeah. So, yes. So, good evening, everyone. So, welcome to this new session of Startup Jargon Buster webinar series. Like I told, this is going to be a practical session, but I've built a deck just for just to explain, like, how the session flow would be and how to build a business plan. Like, what is a theoretical aspect regarding building a business plan and all those things. If at all you have any query or anything, you can always post it in the chat box. And like I have mentioned in the chat box, please don't ask any question which is very confidential or sensitive to your business because this session is being recorded and we'll be posting the recording on YouTube. Okay. So today's topic is building your startup financial plan. So today, for doing a demo of this session, I have considered the example of a SaaS-based startup. So, if at all, like, if you are not from a SaaS background, also, please do listen to this session because it's more kind of how to structure your P&L, how to structure your cash flow, and all those aspects, not like specific to the business model of SaaS. Okay. Yeah. So, firstly, like, why financial planning matters? Because why is a financial plan important is because it would help you in decision making and growth. Most importantly, it helps how much fund you want to raise. Okay, and it also builds investor confidence. Mostly in early stage startups, what I have observed personally is that people typically kind of arrive at a round figure that they are planning to raise this much amount, say XX amount, and then they do the back calculation. But it should not be that way. It should ideally be in a way like where you create a proper business plan or a financial plan, determine what is the cash gap that you are going to have in the next 18-24 months, and that is a fund that you will be planning to raise from an investor. And why it builds investor confidence is because if you have properly worked on your financial planning, if it is kind of realistic and you have taken into aspect all the risk factors and the growth is like kind of realistic and achievable, it would give more clarity to the investor, like where the business is heading. So that again helps them more in their decision making process. Okay, yeah. So we'll just move to the next slide. The flow of a financial model. So typically this is the flow. So firstly, we'll have a business idea, then we convert it to a business model, and then this business model is what we convert into a financial model. And after creating the financial model is where we determine how the fundraising strategy should be, how much fund should be raised, and all those things. So it's idea first, then you develop or work on the business model. What is your revenue pattern going to be? What are your expenses going to be? And like what market you're going to tap and all those things. Then you put all this together into an Excel, which is called the financial model. And based on this financial model, you create the fundraising strategy. Okay. Okay, so I'm like I've told before, I've considered a SaaS model example here for the easiness of explaining. Here, mainly like what things we need to do. Like inside the financial model itself, there are other models like what is your revenue model going to be, what are your expenses going to be, how your P&L is going to be, what is your cash flow, and all those things. For that, we need to have a clear-cut clarity on like how we are going to do the pricing and all those things. So firstly, like we need to understand what is the pricing, what is the churn rate, and what is the user growth. So churn rate is the percentage of customers dropping from your business. Growth is the number of the percentage of customers that you are acquiring every month. And pricing is the monthly rate. Like it's typically called ARPU, average revenue per unit or per user. So what is the average? For example, you have three different pricing plans. You have a basic plan which is 499. You have a standard plan which is 999, and you have a premium plan which is 1999. But based on your experience or like you expect the average to be somewhere around 999. So that is how you determine the average pricing. Okay. But while building the financial model, you can always work on an average, but it would be more realistic if you work ideally on the three part. But for this example or for this particular session, I'm just considering one use case because else it will become much complicated. The idea for me in this session is to give a little bit of clarity on how to kind of build a financial model. Okay. So here in this example, I am taking 999 as the per month user, 15% as the monthly growth, and 5% as the churn. So the formula is MRR is equal to, or the monthly recurring revenue is equal to active users into price. So when I say active users, it is nothing but the current number of users plus what you have grown minus what is the churn. For example, you have say 100 customers in the first month. Then you are expecting another 15% growth in the next month as per this model. So it's going to be 115. But you have put a 5% churn. So that 5% will also go. So 5% of 100 is what? Again 5. So 115 minus 5, 110 is going to be your number of customers for month 2. And your 999 is your per month customer. So 110 into 999 is going to be the revenue for your second month. Okay. So I'll bring all those things in Excel, but just letting you know. Then we have the cost structure. In this, we need to understand like kind of what are the fixed costs, what are the variable costs, and what is the marketing spend. Okay. So here, fixed costs are the costs which are fixed, like salary, rent, maybe like your electricity, or maybe your internet charges, whichever is fixed, like which is not going to kind of change, is called the fixed expense. So whatever volume you do, you sell your software to say 1,000 people, or you sell your software to say 10 people, this is going to be your fixed cost. That won't change. Then we have variable cost, which is mostly dependent on the usage base. For example, you have a sales agent. For that, you are giving him commission. So that commission is purely dependent on the number of sales that he is giving you, or the number of customers that is going to give you. So that is actually a variable cost. Then we have server cost, again depending on the usage basis. For example, if you have more number of customers, the server usage is going to be very high. So the the server cost would increase like that. Then maybe like kind of support staff or anything, which you may be assigning on a project basis, or maybe like when you have some sort of extra task to be done, you may be deploying somebody. In that case, we'll have support expenses. Then we have the marketing spend, which is typically considered as a percentage of revenue. Because if you look at the current day scenario, uh, what we have these numbers called revenue on ad spend, or revenue over ad spend, so ROAS kind of thing. So how much you are spending per, like if you're spending say 1,000 rupees as customer, sorry, marketing spend, what is the revenue that you're going to generate? So those things are there. So typically it's a percentage of the revenue. Like for example, you spend this much percentage of the revenue as marketing spend, your business is going to, typically it comes as a percentage of the revenue. Okay. And where do you increase the profit would be like kind of this fixed cost will remain as the fixed cost. And this variable cost needn't be a fixed percentage of the expense, or the revenue. For example, the commission, what I told, no, it can be in a slab manner. For example, for the first 10 customers, I'll give you 5%. Over and above 10, I'll be giving you 3% only. So the expense would be going down in that case. Okay. Similarly, like I told, the marketing spend, if it remains say 20% or 10% throughout the your entire business cycle, but these fixed costs are going to remain the same. So even if you do 1 lakh sale, or you do 1 crore sale, the fixed cost is remaining the same. Just suppose the fixed cost would change a bit, but just suppose it is the case. So what happens is like when the fixed cost to the revenue percentage would decrease, and that is where you are making more profit. Okay. Then we have the profit and loss sheet. That's nothing but revenue minus cost of goods sold is the gross margin, or the direct expenses. Then gross margin minus operating expenses, we have the EBITDA, or earnings before interest, tax, depreciation, and amortization. And on that, you deduct the depreciation and interest, you have the net profit. These are a few accounting formulas. I just want to kind of give a walkthrough, or like kind of, just kind of a quick recap kind of thing. Then cash flow and runway. Cash in is the revenue or the funding coming. So typically, cash comes into business in three ways. One is by revenue, one is by investment, and one is by like kind of we bringing taking any loan or anything like that. Okay, so that is the cash in inflow thing. Then we have cash out. Cash out is nothing but the expenses, and also the fixed cost. Like apart from not fixed cost, fixed assets. Like apart from your monthly pays or monthly expenses, if you are building an asset, for example, you're buying an office space, or you're buying a car, all those things would come as a cash out, but it's going to be a fixed asset. Okay. Then we have burn rate. Burn rate is cash out minus cash in. So that's typically on a base of monthly kind of thing, wherein we generally don't consider the fixed assets. Okay. For example, you are spending like what, 5 lakh rupees every month. Your revenue is say 1 lakh rupees only every month. So you are ideally burning at 5 minus 1, which is 4 lakh. 4 lakh is your cash burn every month. And runway is the total cash divided by burn rate. For example, you have say what 50 lakhs rupees in your bank account, and your monthly burn, like I said, now it's going to be 5 lakh minus 1 lakh, 4 lakh. So the runway is going to be 5 lakh divided by 4 lakh, which is going to be 12.5 months. Okay. So with the existing fund, and if you are operating in the existing model, your fund will last for 12 and a half months. Okay. So that is what is called runway. These things we have already discussed in the first session also, but just giving a quick glance so that once we go to the Excel, it would become much easier. Then funding ask and use of fund. Determine how much you need to raise. Here, peak. So the ideal fund that you should be asking to an investor should be your peak cash deficit. So when I say peak cash deficit, we'll be creating something, a P&L or a cash flow on a monthly basis, and we'll be ascertaining like which month it is going to be the highest. Okay, for example, why it comes, I mean, I'll explain that when I go through the Excel, but still for you to make it a bit more clear. For example, now you are spending 5 lakh rupees and you are earning 1 lakh. Okay. So, and after a moment, you start becoming profitable. Okay. So at some point, the negative per month gets accumulated up to say 50 lakhs. Then onwards, you are becoming profit. So this negative 50 lakhs would come down to say what? Negative 20 lakh. So ideally, what people would assume would be like kind of, okay, the negative cash that I'm having over 24 months is minus 20 lakh. So 20 lakhs is what I would raise. I want to raise. But the peak cash deficit is minus 50 lakh. So that is the amount that you would have to raise. Because when you have only 20 lakhs in bank account, you won't be able to spend more than that amount. Okay. And plus, we'll ask another 6-month buffer also as a security kind of thing. Okay. Then fund allocation, again, it can vary based on your model. This is a sample example which I took. Tech 40%, marketing 30%, team 20%, and others 10%. And common mistakes what founders make while building a business plan. One is the over optimistic growth, then ignoring churn and delays. Like again, when I say delays, in few businesses, the amount that the customers would be giving would be after 30 days or after 45 days. So these things we need to kind of accommodate into the cash flow of the business. That's very important. Then confusing profitability with cash flow. There is actually a difference between profitability and cash flow. In your profitability, only income and expenses would be coming, but in cash flow, everything can come. The fund that you take from an investor, the loan that you get from a bank, that will come in a cash flow. The asset that you purchase would come in a cash flow, but that won't come in a profitability sheet. And also no clear funding use plan, like how you are going to spend the fund, like which portion, I mean, how much percentage you are allocating to this side, how much percentage you are allocating to that. Those things we don't plan properly. Okay. Then again, a good model tells your startup story clearly. If you can't explain it in numbers, you don't understand it yet. That is I mean, the common notion that investors also have. Okay. Now we'll just quickly jump into the Excel sheet. Does anyone have any doubt till what I've told now? I mean, I have been a bit fast, I know that. I thought like enough I'll explain in more detail when I go through the Excel. If anyone have any doubt, you can please post it in the chat box. I think Suhad has a query. Suhad, if you can, Dinesh, if you can unmute Suhad.
Yes. See,
Yes, sir. Hi.
yeah. Thank you for giving me the opportunity. See, my question is like, when we start preparing the financials document or something, we assume that we will have, if we spend this much amount in marketing, we are going to acquire this much number of customers and all. So basically, we normally, so it's just an assumption. So maybe it might go wrong. It might, it might perform much better, or it might be performing, it won't be performing as we expected. So how can we? So uh, so when we start preparing a financial projection document, so how can we accommodate? Actually, what is the best practice to do in that case?
So if you ask me, the best way to prepare or do that, accommodate that would be to like kind of be conservative. Take the like kind of one thing you have to do a bit of market research, rely on multiple documents, multiple market research thing, like what is the cost per acquisition or cost per customer, or maybe like kind of if it is a cost per click kind of marketing spend, what is the typical range in the industry? Maybe like kind of you can use 4 or 5 documents like that, 4 or 5 research documents like that. And if you're using Notebook LM or anything like that, you can put all these things in Notebook LM and ask it to like kind of briefly help you with how it can be in your model, or I mean, it will give a summary of like what the typical range should be, or even you can work on ChatGPT itself. You can upload all these documents and help it to kind of understand what the range is going to be. And based on that, if you can put like kind of another 10-20% buffer. When I say buffer, it's a negative buffer. Like it's not going to perform that well. See, it's always well and good if your business performs more than your business plan. Okay, it's always going to be very tough when it's not going to be as per your business plan. I mean, it's going to be very negative, or like you are planning for 100, but really it's going to be 10 only. That is going to be very negative. So it's always better, like kind of you take a realistic scenario based on the available research documents and everything, and like kind of keep a 10-20% buffer, negative buffer, and then build on it. That's always my suggestion. Okay. I hope it is clear. Uh, okay, so I'm moving to the example. Is my screen visible? Can you please type in visible? And Deepali, like I'll be like kind of uh, helping you with all those things. I mean, peak deficit and all. That's why I took the deck a bit faster, so that when I go through the Excel, it will be more clear to you. Okay. So yeah. So, yeah, Dr. Siddharth also was asking, like, what is the initial customer? Again, that is based on maybe the question what Suhad has asked. Typically based on the first market spend, or like kind of if you are building a model and you're giving free trial to multiple users and you expect a percentage of people to get converted to a paid model, that's again based on your gut feeling and gut estimate. But again, work on a lower model, work on a conservative model, and yeah. And based on this, like, and you can always revisit your business plan and everything. So here, this is like I've told, this is a SaaS model. So the monthly subscription price is 999 rupees. Initial customer, this is 100. We have taken the starting base, and this is actually a guess or like kind of say estimate kind of thing. Then the monthly growth rate, we are assuming it to be a 15%. See, when we are giving an assumption sheet, you can always, I'll tell you, like, you can always play on these things. I'll let you know, like, how we can work on those things. Then the monthly churn rate is 5%. That is a percentage of customer drop off. Then marketing as a percentage of revenue, it is going to be 20%. Okay. Then we have team salaries, 3 lakh rupees per month. Then we have like kind of Then we have a kind of server or infra cost coming around 25,000, and we have other admin cost of 50,000. Okay. Now let us try to build the revenue model around here. I hope my screen is visible. So we have taken the source base as 100. Okay. So always when you're working on I don't know how much good you are with Excel, but you need to know basic Excel formulas to build a good business plan, because whenever you change any number in this assumption sheet, that should ideally reflect, or ideally that change should reflect across all the Excel sheets. Okay. So you should be good with linking in that manner. And kindly note that this is not an Excel class, so I won't be taking through the Excel shortcuts or anything. But if at all you try to learn the Excel formulas and all those, it would be much more easier for you to work on it. And Excel, not just for financial planning, in a daily business thing, it's very useful tool for many things. You can use Excel. So here in month one, I'm using considering the same 100 users. Okay, clear. So 100 is going to be the active users. So like I've told before, uh, the in the month two number of users is going to be what? 15% growth over 100 minus 5% growth over 100. Why? Because 5% customers is dropping off and 15% customer is growing. So ideally it is 10%, but I'm not doing it like that. So if you look at here, so it's 100 into, so I'm taking 1 plus this 15%, okay, minus again 100 into what? 5%. So if you look at the formula, it's nothing but 100 into 100 plus what? 100 into 15% minus 100 into 5%. So that is the number I have taken. And since we need this to be a whole number, I'm just using the round formula also. Again, these things you can always check and visit. I'm just okay. Just check the procedure how I'm doing. Okay. Now we have 110 here. Now I'm dragging the same formula down, which means that I'm using the same formula till month 12. Okay. So based on that assumption, we'll be having 121 customers in month 3, 133 customers in month 4, 146 in month 5, and so on, and 285 in month 12. Okay. And what is the per customer rate? So per customer rate is 999. So what is MRR? It is active users into per customer rate. So active users is what? 100 into, again, it's going to be 999. Okay. So 99,900 is going to be the first month revenue. Month 2, it is going to be 1,09,890. And towards month 12, it's going to be 284,715. Okay. Now, here ARR is nothing but MRR into 12. ARR is just a number matrix which we may be required to tell to the investor on an investor call or something. Okay. Now we'll forecast the expenses. So team salary, like I've told, it's going to be what, 3 lakh per month. We have done here 3 lakh. This is going to be same across all the 12 months. Okay. Why? Because there is no change in salary for next 12 months. Server or infra, we have considered as 25,000. Again, this is also going to be the same 25,000 across 12 months. Marketing, we have assumed to be 20% of the revenue. So marketing is 20% into, okay, the revenue, per month revenue. Okay. So we are considering it here. So I've dragged down the formula here. Okay. Same formula only. It's 20,000, 20% into that formula. Then we have admin cost of around 50,000. That is also going to be spread across 12 months. I mean, same this one itself. And the total expense for 1 month is month one is sum of these 4 heads. Okay, so it's going to be 3,94,000 and it will go up to 4,31,000. Now we'll go to the P&L. So P&L is nothing but revenue minus expense. So what is a month one? We'll take the revenue month wise. So here we have say 99,900. Till that, I'm just copying that. Okay, I'm using equal to formula. Equal to what is there in the previous cell to, or what is there in the link cell which I have mentioned. It is revenue build up C2. So C2. So I'm putting it to what here itself. Okay. Then I'm dragging, so it comes to C2, C3, C4, C5. It comes up to here. Similarly for expense also, I'm considering the same thing. Okay. So the EBITDA is going to be this minus this. Okay. So if you see like the EBITDA, like the loss is coming down. Okay. Which means that the business is in the path of profitability. Okay. Now we'll take cash flow also. So while taking the cash flow, I've just build a simple model. I haven't considered the asset cost or anything here because I'm working more on the runway part. Suppose we have say 1 lakh rupee as cash in the opening month. Okay. We put in 1 lakh first month. The net cash flow is nothing but your negative EBITDA because in month one you are spending 3,94,000, but you are making a revenue of 99,900. So you are spending 2,95,080 rupees from your hand. The closing cash balance is going to be nothing but what your net cash flow plus, or maybe your opening cash plus net cash flow. So 1,95,080 is the closing cash. Same, the closing cash balance would become the opening cash balance for month two. I'm dragging it down till the end. And this same formula I'm dragging because I'm taking the monthly expense here. Okay. So this thing I'm putting it here. I'm dragging the same formula here. And this closing cash also same formula. Nothing. Opening cash plus what is the net cash flow. So if you look, it's going to be 26 lakh 92,909. Here currently I'm not putting runway because we may not be having currently we have not raised any fund. And this funding plan I've just kept as a sheet like to understand how much percentage we are putting towards technology and all. And this again can vary based on your business requirement and everything. Okay. So now here, if we extend this business plan, okay, now we have built it up till what? We have built it up till month 12. I want to explain that peak deficit concept and all. So I'm extending it up to say 24 months. Let us see if it will become profitable there. Okay. So till month 24, I'm taking it. Okay. Now let us go to the P&L. This is nothing but I'm dragging everything what I've dragged till month 12 to month 24. Okay. See, the business becomes profitable now. Here. Okay. Okay. Fine. No? Now, okay. So Deepali was asking me about what is the peak cash deficit. So if you look at the closing cash here, and for example, you build a 24-month business plan, and you tell that your cash deficit is 18 lakh 31,000, you need 18 lakh 31,000 to be raised. Okay. But with 18 lakh 34,000, how you won't survive beyond the seventh month. Because in eighth month, your cash deficit is going to be 19 lakh 86,000. Similarly, the peak cash deficit, which is the minimum of this. Okay. So here, okay. So I'm using the minimum formula. Minimum of why minimum? It is because it's a negative. So it's 30 lakh 38,240. So this is the peak cash deficit. Okay. So this would be the minimum amount that you'll have to raise from the investors. Plus on top of that, I have told like we'll put a 6-month buffer. So what is your monthly expense going to be? It's say what? It's 5,53,000. So maybe I wouldn't recommend you to go for a 6-month buffer here because the business is already turning profitable. So at 30 lakh, 38,000 plus, let us say we are taking 3 months, this one, 3 months expense. So into say 16 lakhs, another 16 lakhs also will add to the 30 lakh, 38,000. So the ideal fundraise would be somewhere around 46 lakhs or 47 lakhs. Maybe we can round it off to 50 lakhs. That would be the fund that we will have to raise from the investors. Okay. Now I'm leaving this to you. You can ask me questions because I think that is the only way. Because oh, sorry, I'll just share the screen again. But open to your questions. I think that's the way in which we can kind of clearly work this out. So over to you guys. You can ask me questions. I think that is how we'll figure this one. So Suhad is asking, is there any way thumb rule on how much we should spend on? There is no particular thumb rule, Suhad, which basically depends on the industry you are in. It depends on the like kind of your business model and all. Okay. This Excel templates and everything I'll be sharing. No, don't worry, Masum. I'll be definitely sharing. But if at all somebody can come up with some question, I think the session can be a bit more interesting. Because I know since it's being a bit more numerical or like kind of those kind of thing, no? Being a bit more technical, I think it's better if somebody asks some question. So Ajish is asking, please explain what is a deficit. So deficit is nothing but uh, kind of deficit is nothing, Ajish. Deficit is uh, your cash inflow minus cash outflow. If the cash outflow is more than your inflow, that's going to be a deficit. That's it. Nothing. I mean, it's just negative cash flow. That's it. Okay. See, Mosum, I haven't considered the capex management here. Okay, and break even, all those things again, it's another whole different thing, Rajesh, because I don't want to take this session too much deeper or make it too much elaborative. Maybe like we can have a separate session on break even. This capex thing I haven't considered here because again the Excel sheet is going to be complicated. I just want to kind of give you an understanding on how you can work out for the cash flow and all these things. But once you are clear about how to build a business, basic business model, I'm always happy and I'm always open to kind of building a detailed model. Maybe wherein we can typically consider the capex part into consideration, where like Ajis was telling about the break-even point and everything. Okay. So again, expense on support, again, Ajish, it can vary from different business. For example, here what I have considered as support is maybe like when you have peak business hours, you may be requiring some support staff or some support expenses or something. Maybe like you'll have to take some laptops on rental, which is not going to be a fixed expense, just for the couple of months where you have peak business hours. So that's what I have considered as support here. It can, again, the terminologies can change for multiple people. Dr. Siddhant. Yeah, I'll just unmute Dr. Siddhant.
Yeah, hi, Abhijit.
Yeah, hi.
Thank you. Thanks a lot. This was very insightful, much required. I wanted to ask the peak deficit point which you mentioned, isn't it corroborating to the break-even point in this model at month 18? Is it if you are getting positive cash flow net?
See, it can be treated as like that, but why? Because I won't take it as break even would be. See, it can be, for example, in this month we turn profitable. Okay, maybe in the
Hmm.
next month again we can turn into loss. That possibility is also there. Break even when we compute, it's again a different model.
Okay.
Ideally, it should be coming in that way. But for
Okay.
example, for example, in month 18, okay, here you are
Okay.
expect. For example, you have some fest. You're into some say D2C brand.
Okay.
You're expecting a festival sale, Diwali sale. You are expecting
Okay.
that month can be profitable. But
Okay.
again, after the next month, the November month, you will become loss again.
Got it.
The real
Mhm.
break even is going to happen only in what April or May. That is why I
Okay.
haven't considered that as a break even.
Okay. 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 Fine.
Yeah.
Thank you.
Yes. So ideally, in a ideal scenario, it should be like that only, like how we have told. If anyone have any other question, would be better. Or if you don't have any questions, we can wind up the session as well. Maybe like kind of like how Ajish was asking, we can have a or Mausum was asking those things we can consider in a detailed business model session, which I'll make it like kind of in a very close circle, maybe like kind of 4 or 5 people, rather than doing a session as a whole. That's something what I can help you guys with. If you're interested for that, you can uh, ping Dinesh on that thing. Dinesh's number would be shared. This Excel format I'll be sharing. No, don't worry. I don't know the name. It's written SS. Yes, so Siddhant, like, so Dinesh should be sharing the WhatsApp group ID, and I mean, you can stay in touch with Dinesh. He'll help you to like kind of how to connect with me for a one-on-one session. This model, so Ajish, the basics would be same. I mean, the basics would be same, but in model we'll have to make a lot of changes. That is why I've told it's a SaaS model. Even if it is a D2C model, your metrics would change because there it is going to be GMV, gross merchandise value, how much you're going to sell. If you're doing a contract manufacturing, there is going to be a like what manufacturing expense going to be there. On top of that, you'll be having labor charges, you'll be having shipping charges and all. So those things also would be there. So I mean, the overall model would be same, but we'll have to break down the Excel. Yeah. Anyone else have any questions? ARR is annual recurring revenue. So it's nothing but monthly recurring revenue into 12. So typically in a SaaS model, we use this MRR and ARR kind of thing. So if you're making, say, what, 1 lakh rupees every month, you're expected to make 12 lakh rupees in a year. So these are key metrics which investors ask in a pitching this and all. So net cash flow, Siddhant, I have considered as an opening cash of 1 lakh rupee. That is why it's coming like this one. So it's opening cash 1 lakh rupees. Net cash flow is nothing but the loss what you have seen in the P&L. So this 1 lakh minus or plus minus 2 lakh 95,000, you get minus 1 lakh 95,080. Okay. So yeah, again, like I've said, no, I'll share these Excel templates with you. Please work on these things. I mean, if you're planning to build a business model or financial model, please try to kind of consider, I mean, work on these aspects. Then it will be much more easier for you. For this purpose, time value is considered or not as cash now. Time value is not required, Vijay, in this model. In the business plan, time value is not required. Time value you will consider only during valuation perspective and all. Time value we don't typically consider in the business model. This one because that doesn't have any, relevance for in building a business model. It has relevance when you're building a discounted cash flow model valuation sheet or something that there is a lot of relevance for the time value. Okay, there are no more questions. I think we can wind up the session. I'll share these templates with every one of you. And Dinesh has shared his contact number. You can reach out to him for any one-on-one session or anything. And if you have any queries, on top of that, we'll be sharing the WhatsApp group link also on mail. Okay. So thank you, everyone. Thank you. I mean, have a good evening, everyone. Bye. And we'll update about the next session. So bye.